Live out here. Good afternoon and welcome, ladies and gentlemen. It is the HQ of the BB at the TCC. That's right. The headquarters of the Cash Compound with the Banking Bros. We got a brother from another mother here in the studio with me, Jay Dew, your host today. And I see Coach Jesse on my right. What's up, man?
Hey, buddy. How you doing?
I'm good. All right. Can we hear Jesse?
Hopefully so. Yep.
I need more snare in my headphones, as Eminem said on the front of that track. I don't hear him in my headphones. Sean, how about you, man? I see you out there as well.
Yes, sir. I'm here. Loud and clear, right?
Yeah, man. I got you. Very good.
All righty.
Everything good? Okay.
Let's see.
Very good. He's close to me, so I can hear him.
I can hear Jesse, so we're good.
Okay, you can hear him. So, yeah, we are good. Welcome, everybody. We're live on a couple of platforms out there. Once again, it is YouTube at The Banking Bros. It is the Cash Compound Facebook page, and probably also streaming live in our group called Infinite Bankers and on our Instagram channel at The Banking Bros. So we're so happy to talk code cracking cash flow for you in this cash coaching hour in May. It is noon 05 on the East Coast here, but all across the country, down here in the 51st state, or you trying to make America great? No, 51st state is up there. Make America great down here. Wherever you are, we got you. If you're in North America, US or Canada, we can help you understand how you can place your wealth in a place designed for your future. And with that same place, we're not going to get out of the today, the now. We're going to be able to plan for both of these things. We're talking about the ideal asset and structuring your life in a way where all of your food, folks, and fun can be handled with care. You remember that commercial, Jesse? Food, folks, and fun.
No.
Not at all.
No.
Okay, Sean, do you remember which fast food chain had food, folks, and fun as a part of their marketing lure back in the day?
I am 33 years old, so you are a little bit older than me, so I don't believe so. Food, folks, and fun.
See, I didn't say that part out loud, but Sean did.
What are you talking about? I got a little Vaseline, a little Lubriderm. I'm moisturized. I'm not older than any of these cats here, but
I'm going to take a shot and say McDonald's.
I think it was either McDonald's or Burger King. Yeah, food, folks, and fun.
You're not even certain after all.
I think it was big. I think it was Burger King. Food, folks, and fun. You remember McDonald's
memory goes with the age, apparently, like you were saying, Sean, right?
Yep.
Remember McDonald's for a long time was "Have you had your break today?" You remember that one?
Nope.
I do remember that one.
Okay, very good. Y'all don't be watching enough TV. But everybody else, we are glad you're watching us. And remember, part of the goal of this engaging conversation is to get your questions, comments, and concerns. Put them in the chat. We want to walk and talk through them to help you understand what's going on in your own personal economies. We want to help you with all that stuff. And we want to lead you toward a absolutely free coaching call with me or one of my great coaches here who practices the programming that we're going to teach and preach today. We love to lean into the idea of infinite banking concept. What that is utilizing a guaranteed lifetime contract for you and your family that is a private and liquid asset for your money to be able to fund whatever you want to do. So, Jesse, I just came off of chatting with our team. We have an internal family meeting right before we go live each Thursday, and there's about 10 of us who are on this team who walk and talk through this infinite banking concept approach.
Yep.
And I was talking about money being the fuel, the tool for the stuff you really want to do. And first, I mentioned faith. These are kind of the foundations of freedom: faith, family, friends, fitness, finances, and fun. Do you believe that kind of encapsulates what we're supposed to use money for? Like, what is this tool all about? How do you kind of interpret that in your own life?
Yeah, I love that kind of a framework, the finances, the family, that play. I think that for me, for some time now, I've had a handful of priorities, and that's them in a nutshell for sure. And money is going to be directed to all those areas in life because I want to improve and I want to grow, and we have needs and we have wants. So sure, absolutely. I bought the barbells. I bought the squat rack, right?
There you go.
For that fitness area.
Okay.
I paid for the vacations. I pay for the property taxes in our home for our family. So it's just like, yes, there are applications in all those areas for me.
Very good. And you mentioned fitness, one of the F's that I thrown in there for us to think about and upgrading our life. But it's not just physical fitness, I think. Sean, it's also psychological, mental fitness, emotional fitness. So I like to kind of expand on that one as well. I've had a lot of stress in my life over money. Year after year, coming up from a kid, it seemed my parents were stressed over money. So we're not just talking about fitness physically. Why don't you bring up psychologically, emotionally, how money is supposed to help us as well, and what it's supposed to do for our mind and as well as our body?
Yeah, I think one of the biggest things, because I'm right there with you, I had a lot of, I think everybody in most cases, 99% of people have stress about money growing up. They've seen their family stress about money, whatever it may be. But I think just having a better understanding of money as the tool that it is, the exchange form that we use to pay for things will bring a lot of clarity. And we were talking about this earlier in our family call, which was understanding how it's flowing through your life. It's really stressful when money comes in and then it seems like it just goes right back out and you don't understand exactly where it went.
Mhm.
I think when you don't have to name every dollar, but I think when you have a budget that you're able to follow and you understand where that cash is going, it just brings you a little bit more peace of mind knowing that, hey, if I needed to, I could cut back here so I could increase here. If I want to put more in my savings, maybe I should look at a little bit more of the things that I'm doing. Maybe I'm eating too much of that McDonald's on a frequent basis, and that's making me go to the gym too much. But just understanding the relationship that you have with money is going to help a lot. And I think you can get that from reading more, listening to more educational videos, and just understanding how you've been taught about money growing up, the places money should go, the things that you spend it on, your overall money habits.
I love it. Thank you for that, Sean. Want to shout out to Jake out there in YouTube land. He's close by. Jake is a client of ours, came into the office. Most people check in with us remotely all over the U.S. and Canada, but Jake was about 45 minutes or so away from here. Both Jesse and I got to meet and greet with him. I saw him in office first with the missus. Jesse has chatted with him over the phone, and we've given him some coaching and clarity around what he knew to be the place for the brain trust of IBC, and that's the Nelson Nash Institute. So shout out to you, Jake. I know you are close by right now, and we're happy to have you on board. Ask your questions, comments, and concerns always goes into the chat. If you have any substitutions, exchanges, or refunds, throw that in there with us as well on things you don't quite understand. We're here for you in that regard. This week, Jesse, I want to talk about some of the coaching calls that I've done. And I know you do them as well. They're free, right? You're still not charging anybody.
Still free.
Okay. So this week, I had a call with a friend who's become a friend. You know, so much of what we do around here, talking about people's concerns, maybe the stresses they have, like Sean was mentioning, about money, helping them get a framework to understand how we can use it without losing it and abusing it and utilize it. We become friends. We become friends with these people. We become acquainted with their life. And my buddy's in Hawaii. Okay. So I talked to him this past weekend. It was over the weekend. He's had a contract on himself and his life and the missus and on her life with us for about 4 years. And he was ready to get out of debt.
Awesome.
Ready to get out of debt. Looking at his situation, Bank of America had him coming and going 4 ways with 4 different cards. And first off, when he utilized a tool that we have free for everybody who wants to engage with us, where it was going to show you how to utilize your money to get out of those debts.
Yep.
Everybody seems to have a come to Jesus moment when they realize how much interest is leaving their household. Talk about that for a second. Help us get a framework for all of us out there. Maybe Logan, we see you, Logan. Appreciate you coming up, and all of our people on IG right now. But tell us about the debt that's leaving your house in Hawaii and headed to Bank of America or wherever you are in North America. How much debt is really, do you feel that it's crippling the average family, or they don't understand, or do you think he was typical?
I think that he's typical. And then I also think that when it becomes apparent to somebody that they are ready for a change, I think that's first and foremost, right? If they don't want to do anything different, they're not going to do anything different. Now, this is a great case, and you'll talk more about that, I'm sure, to where this individual, even though they had debt, they'd also been capitalizing policies for a significant amount of time. So they had some assets that were built up that they were able to put into motion. But let's say somebody's starting from scratch. My primary challenge to everybody when they want to get debt out of their lives is, well, pin a number to it. Go and look at your statements. Go and look at your accounts. Go and look at the things that you are paying for currently. Find out how much you're paying total. How much is leaving the house total, right?
Okay.
And then look at how much of that total number is principal on the cars, the homes, all of it, right? Calculate all of it. That's my challenge to you. And how much of it is interest. I think there's such a burning fire that would start in somebody that actually looked at what that number is and realized that that interest amount, which is typically the lion's share, right? Most of that premium, most of that payment, is going to be going towards interest, and it's just evaporating. You might as well be lighting it on fire and burning it up, right?
Sean, what do you think about that? What I heard from Jesse here is volume of interest, but I didn't hear him say one word about interest percentage or rate. And I think most people might be thinking that. What have you learned in your experience over coaching?
Yeah, it's definitely about volume, not about rate. And Jesse, I so spot on, especially if you want to get real upset, look at your amortization schedule on your home that you own, if you own a home. Because essentially what happens over that 30-year mortgage period is you have now bought you a home and you have bought the bank a home. It's normally about double, maybe a little bit more, depending on your scenario of what that home actually cost you. So imagine just having all of that money back working for you over that period of time. So that's one thing that I've noticed as well with clients is they just don't understand. They don't have somebody that's taught them how to calculate those numbers, how to look at that stuff. And so they're totally fine, not knowing, but losing 34.5 cents out of every dollar that is just going out to third parties. So again, I think it all comes back to what we do as coaches is just kind of sit down, have this one-on-one or this family chat with you and yours, and walk you through the process of what's actually going on. Because I think once you understand what's actually going on, you have more clarity around what type of actions you want to take to get something done. So again, that's why you need a coach. We have coaches. We all have mentors. We have these people that help guide us through these things. It's just one of those things that'll help provide clarity in your life.
So if you want to have that conversation with you and yours, like Sean mentioned, let's get on that call together. It can be me, it might be Jesse if you relate to him, it might be Sean if you feel that that's the vibe for you. We'll walk and talk you through how to go and assess your situation. And let's figure out where you are. Now I'm going to jump into my Hawaiian friend here in a second, but I've heard recently, it just came back, is when you're on the battlefield, and you're on the battlefield of life, we'll use that as the analogy. The battlefield of life, the battlefield of your money, figuring out what's going on. If you wake up in the middle of the battle, what's the most important first thing to know? If you wake up on the battlefield. And it was a very interesting thing for me to realize and to hear from someone else who first pitched this idea at me. I didn't know. I didn't make it up. I steal everything around here. What do you think it was? You wake up on the battlefield. What is the first thing that you should come to grips with?
Where you are.
Yes, where you are. That's what threw me off. Not where the enemy is, not just where you are, right? Compared to everything else. Where am I, right? Am I behind enemy lines? Am I on the offensive? Am I in the dirt? Am I above the battle. Where am I? First off, that was very interesting. So let's figure out where this guy was. And I'm going to show you the 3-cup setup, one of our flagship ways to illustrate how a policy for you, a contract, is designed for you to get cash out of for the now, so you can pay off those debts. Let's say you might have a huge amount of volume and you may be paying for that house twice. You know, if your interest rate is between 5 and 6% over the course of a 30-year mortgage, you will pay for the house twice. Isn't that wild? Isn't that wild?
I'm glad Shaw brought that to the attention.
Yeah.
It's so big.
Okay, Just Code It. Appreciate you out here on YouTube. Remember, you can find us on the Banking Bros on YouTube. We have a lot of mid-form and long-form content there that can be very helpful to you if you really want to dive into this. For those of you on Instagram, TikTok, or just on our Facebook pages, long-form content is being built by us every single week where a couple things come out. Let's jump in here. Go
Slide
ahead.
those cups towards Jesse just a hair.
Yeah, I couldn't tell exactly.
Yep.
Appreciate
right.
you.
Yeah, there we go.
Yep, you're good there.
Okay, let's get into it, ladies and gentlemen. Cup 1, 2, and 3. The red cup, cup 1, is where our premium goes. And our friend in Hawaii was loading up his premiums in his whole life insurance contract for him and his wife, 2 separate contracts for the last 4 years. Now, if you give an insurance company premium, you know that's got to buy you some death benefit. This is life insurance, so the contract states that the promise to pay and the peace of mind you get is a bunch of paperwork with a pool of money that we must pay out. That's what life insurance is for.
Yep.
Okay, in these specially designed contracts, we're going to put riders on them on purpose to accentuate the equity. Cash value, cup number 2, right here in the middle, the green one, is how much net present value you have in this contract. I'm not dead, neither was he. So today, there is a value that in real estate, of course, we'd call equity. In life insurance, it's called cash value. Cash value can be an amount of money. It's a number, and we can turn it into money in our pocket. Because we're not dead, we can call the insurance company or log in and say, hey, show me the money. I'd like to utilize the net present value of my contract, and we're going to take a loan against the collateral, the policy, the payout that we have. We're going to take a loan against that, and we're going to get out of Bank of America's 4 credit cards.
Right.
So this guy, Jesse, has got 4 credit cards ranging from about $5,000 to about $8,500.
Okay.
The lowest interest rate is 18 something, and the highest interest rate was 22 something. And so that's how much. You can write it down here. I'll ask you a question or two about that. So let me give you the scenario of his policy's performance up to that point. His policy's guarantees was a death benefit, he and his wife. The performance so far, the equity so far, was an amount of money that was equal combined about 30 grand. Okay, $30,000. So this guy has life insurance that he can leverage. That's what we want to help you guys understand. This is a private contract. It is not taxable. It is growing and ever increasing in equity every single month and every time he puts more money into it. Mm-hmm. The death benefit was designed to go up and rise every time he did it, but there's more and more leverageable cash value. So this man had 2 policies, he and his wife, but he's got what did you write down there for our debts and our available cash value? I'll ask you a question or two.
Yeah, no, I was just writing the 18 to 22,000, 4 cards, 5,000 to 8.5 each.
Yeah, okay, 18 to 22% on his 4 cards, ranging from 55 something to 85 something. And this is what I said. Well, how would you advise this person to think about the debt that he has and the money that's available? Just how would you advise him to think?
Well, the starting point for me is I like working from a point of strength. So when someone prioritizes debt recapture, I would actually suggest that they also simultaneously consider, okay, what capital do you have access to that you could actually set aside and maintain for your war chest, your emergency fund? That way, while you're working through the debt recapture, you don't get side railed by something else that pops up, perhaps, right? Because future's unknown, never know what might come our way. So actually, I like prefacing by saying, well, okay, what amount could we set aside? We're not going to put necessarily towards even this debt recapture, although I know that's priority number 1 for you right now. Yeah. That's where you're at. You're real focused. But let's get a number there that works for you, that you pick, that you choose, and then we start in on the debt conversation.
I love it. Okay, so I got to stop him right there. Sean, he is exactly spot on to where I was thinking. This man had 2 policies, and I suggested he think about, I cannot tell him what to do. That's
Sure.
not the point.
Sure.
I suggested he think about not utilizing one of the policies so he could have his, what you call a war chest, an emergency fund. That's exactly how I said, where is your money? Because if it's here, which I assume it was, I didn't ask him about his checking and savings. I assumed that they were having money come in and go out pretty regularly. You know, it kind of zeroes itself out. We just made that assumption. So I didn't ask him about that. I said, if this is where your money is stored, then I might think through not utilizing one of these policies for your debt recapture. You use that word recapture. Now, why do you say that? When we're going to leverage one policy, 15 grand, we're going to start using the money that's available, income tax free, leveraging it right now to get out of those crazy debt totals and debt percentages. Why did you say recapture?
Yeah, recapture in the sense that currently he is indebted to, he is captive to, he is subject to, okay, he's abdicated the responsibility and the opportunity to Bank of America in this instance. Could be anybody, but if it's that third party, like Sean was saying, then we're going to be paying for twice of what we should have. So I want to recapture the position of control. I want to recapture that debt. So I will still have a debt, but it'll be a private debt. It'll be a controlled debt, right? Because when the insurance company lets us have and we've got this right. We've got this right. We're not asking permission. We've got this right. When we make that policy loan, leveraging our policy with the insurance company, now we're controlling those terms and conditions. We get to decide, because we've recaptured that debt, when we're going to pay it back, how we're going to pay it back, if we're going to pay it back.
Okay, Sean. All right.
No.
Give us some practical use to that. I'm giving everybody a scenario for a guy they've never met, never known, but I know you have done this. Get granular for us for a second. You've been generic a few times on this call, some of your stuff. I love it. It's very good. But you have used this same system to have inside debt rather than outside debt, right? So I'm going to change the wording up a little bit that Jesse said, but
That's
explain to us the debt you got rid of and why you're okay with the debt you still have.
For sure. So I'm going to use this guy's example really quickly. Let's just say he's got that $5,500 card. That's his lowest card.
Yep.
So in this scenario, what we would do, just specifically focusing on that card, let's say that card's 18%.
Okay.
And he's going to take a $5,500 loan from his policy, and we are going to, from his cash value, in his policy. So cup number 2 here. And he is going to pay off that card with Bank of America. That $5,500 is gone. He now has a hole in his cash value of less than $5,500 because he took that out and he paid off the card with it.
Okay.
But what was he paying to the card on a monthly basis? We don't know exactly what that number is.
I'll tell you, actually. So I had those numbers here. I can bring them up. That maybe about $250.
Okay. So he now has $250 that was going to Bank of America to pay for this $5,500 credit card. We've now paid off the credit card. He has $250. We are now going to redirect that $250 back to our policy as a policy repayment loan, back to ourselves. And as we do that on a monthly basis, our cash value is going to start to increase. And every time we make that $250 payment back to ourselves, we are, just like Jesse said, recapturing that interest that we would have been paying to a third party. But that $250 is now accessible for us to use again. So let's say he didn't have $15,000. Let's just say he had the $5,500 total in accessible cash value. As we pay that $250 back, we'll start stacking that up again until we get to a point where we feel like we can take another loan out from our cash value to pay our next card. So what he's done now is he's taken that, let's call that card the 18% that he was paying to that third party, Bank of America. He's canceled that out. And let's say his internal loan rate within his policy for accessing the cash.
I can tell you what that is as well. So he had a policy that was 5.02,
Okay.
and a policy that was 5.28, just so you
Okay.
know. Mhm.
So when we loan money from the insurance company, remember, they're not giving us our cash that we originally put into the premium. They are giving us a pool of their cash. So they are loaning us that money at in this case, 5.02% rate. So when Jadu said turning outside debt to inside debt, debt we don't control, that we are required to pay, or they're going to come for us, to inside debt that we do have control over, he now has a loan that he owes to himself of $5,500. Now, again, he makes the rules. He gets to pay that back when he wants to pay it back. But what we teach our clients is to be good banker. You're going to not take that $250 that he was paying and go and blow it on something else. You're
Right.
going to redirect that back into your policy, build your cash value back up until you can disperse that to go pay another loan. And if you're smart, you're going to pay a little bit extra so we can make that happen a little faster, and you're going to make your policy grow throughout that process. So that's kind of that recapture process. And we're going to do that multiple times over. And our program that we have will show you, if you do this in this order, your timeline of potentially paying off this debt, which tends to be faster than it would be, and what you've recaptured, your policy growth over that whole period. It's pretty awesome.
Oh, love it. I love that explanation. There are two things I want to dive into if I can remember them both, Jesse.
Okay.
Number one is, what if this guy or anyone else that you may talk to, if you've talked to people like this, are thinking, I want to take a loan against my policy, trying to understand it, to pay off that outside debt. Yeah, I want to get out of the 18+% at Bank of America. We get it. But they don't want to repay their policy. If it's mine to own and control, I don't feel exactly the same way Sean explained it. And this guy was in that category. So he's slightly different than Sean. He's saying, hey, I've got 3 other cards, man. So should I be redirecting this $250, that payment? Some of those cards had $150 payment, some had $250 payment. Should I be directing it back into paying off my policy? What about the interest that's leaving our family's life? It's leaving the island of Kauai. He was on the island of Kauai. I'm saying too much about this dude, but I like him. It's leaving the island of Kauai. It's headed to Maui and the Big Island and the mainland and Bank of America, wherever their headquarters are. I need to pay off the other cards. So, like, should I be paying this policy back? What are the implications, ramifications, and consequences of not doing it like Sean said? Because I got other bills.
Well, what a nice position to be in, to where you are the person that has that control to make that decision and choice.
Yep.
Like
Okay.
he was
Okay.
saying. So yeah, you could take Sean's exact example, and because you're the one that is in control, you could change that last step. You could change the policy loan repayment into just snowballing into that second card, third card, fourth card. I mean, that's what I did in my example too. And so when we started paying off our cards, then we started building up into paying off student loans. When we paid off student loans, we were keeping more of our cash flow that had been monthly bleeding out to these third parties. Well, then we got to snowball that into the family car, and we paid off our family car. So absolutely, when you're the one in control, you're the one in control. So yes, he could decide to go right to that second card from the first card and just
Okay.
keep going up the line.
All right. You said it was the last thing that he said, but I disagree. I remember the second thing that I wanted to bring up. The last thing he said was paying interest, overpaying the interest back to your policy.
Okay.
Overpaying the interest back to your policy. So let's say we take out a loan, $5,500. This guy in particular had a policy loan interest rate of 5.02. And so what are we talking about when we say, now I have an interest charge on this money from my own system, my own policy, and if I pay it back, I get it, the company gets it, my policy gets smaller, bigger, my debt's still here? What's going on there? A lot of people get confused here, and my guy in Kauai was also confused.
Great. So if you take that 18% on the amount, that $5,500, whatever it was, and if you were going to pay that to Bank of America, which you were, and you decide instead to recapture that with a policy loan from the insurance company that's only charging 5% or so, simple math tells me that if I make the same payment that I otherwise was, that $250 a month, but it's not going to Bank of America now. I took the policy loan, paid Bank of America off. I'm just going to take that $250 a month now. And let's say I do put it back in my policy. Like Sean was saying, I do that. Well, haven't I improved my situation by 13%? Yes, I have. But what Sean was saying about being a good banker is exactly right. If you just keep paying that $250 a month for just as long as you would have to the Bank of America, but here instead, the insurance company was only charging you 5%. Where does that 13% go? Well, that's cash flow that got freed up that you don't owe the insurance company, don't owe Bank of America anymore. What should you do with that? Our suggestion, what Sean was exactly saying, was that that can also go into this private system that you own and control now. What it does for you is it creates cash flow that can go into this cup number 1, premium cup. You get to redirect that cash flow that was just interest that you're bleeding out to Bank of America. And now that's even more capital in this beautiful system that you got to use to get out of that debt in the first place. And every time that you put more premium into this system, the death benefit is going to increase, the cash value is going to increase, which again, then leaves you where we were, which is, do I want to go and pay off card number 2 now? Do I want to go pay off card number 3 now? Or do I just want to build my emergency fund bigger now that I have got that first cut out of my life? And the answer is, well, you're the one that gets to decide.
I love that. Thank you for that, Jesse. I think more and more people are starting to understand, but when they get into practice with this, they need to be reminded. They need to be around the campfire. They need to be reminded of where this money is going and flowing and who's getting it this time. Because is it leaving your house? You mentioned specifically that the amount of interest that he was paying on all cards combined over the course of time
Massive.
was $9,000 a year. Okay. $9,000 a year would have been his interest payments and the volume that you told us to calculate first thing. And if he has outstanding loans, the way we were thinking about paying them, he would actually have interest charges to his system, the money, right? The system is a bunch of money that they owe you and they must pay you. It will come out at death and things like that. Interest charges that could amount to the total of $2,500. So he could choose to pay Bank of America what he already signed up for, like you said perfectly, $9,000, or he could choose to have the inside internal debt with his life company partner that also gives him growth, also gives him liquidity, also gives him control and privacy, also pays dividends annually that he can now reinvest into his system. He could give them $2,500. And when we finally got him there, he was like, oh, I'm not worried about my loans then. And I said, that's a bingo. You guys remember Aldo Rain and Hans Landa from that Django movie? Not Django, the other one. Inglourious Bastards? That's a bingo.
Yes. That's
a
favorite.
bingo. And he was like, is that how you say it? No, you just say bingo. Oh, bingo. There it is. All right.
I got a point to
tell
make.
Tell us more. Yeah.
So you mentioned, I think one of the really cool things to look at here is these are both businesses. You have Bank of America, which is a business, and you have the life insurance company that you have your policy with, which is a business. When you pay that $9,000 to Bank of America, does that do anything for you individually for increasing your financial position?
No, not at all.
It does not. Because how much of Bank America do I own?
Nothing at all.
No, I don't know. When you're doing business with a mutual insurance company, you are in turn a partial owner of that company. So think about it like this. When I pay interest that they're charging me, that 5.02% to a company that I partially own, and that interest that they're making from my loan is increasing their overall books for their year. And those books, the better they look, the better my dividend looks at the end of the year. Did I really lose out because I am a business owner whose business is doing better by me paying interest to my business? Or am I better off by paying $9,000 in interest to a business that couldn't give squat about me? So
I love it, Sean. I love it. So I have two things to say on that. One of which I showed my buddy over the course of our call this weekend, and another one that I will have to tell you guys because I'm not normally the board operator. That's normally my brother Jonah. He is on a trip in Europe right now, so he is not able to be here and operate all of the board options that Jesse is in control of right now, like sound effects and
I could
visuals
just
and stuff like that.
randomly push something.
Hey,
Sure.
you can try it. Take us off the air. Be careful. And the one thing was the dividends. Sean brought up dividends. We're going to utilize mutual insurance company contracts from life companies. Okay. I went to an event recently with the NNI Institute, and I said, oh, maybe we can shorten it to life company rather than life insurance. I just like the way it sounded a little bit. I might try it and say life company. So the life company I've got a contract with is a mutual insurance company, meaning, like Sean said, we as individuals get to be shareholders. We get to be stock holders, participants. We get to be owners in the deal, unlike Bank of America. So, Jesse, why that's important is these dividends get reinvested back to us. We get a cut every year. And that cut can be taken in cash or it can be reinvested into the system, which is what we normally teach and prefer. Here is a copy of a policy that I have that started in 2017. Where's my date here? 2017, May 1st, 2017. So this is current, ladies and gents. And my dividend this past year, Jesse, can you read that? I'll make it bigger.
$238.04.
Okay,
$238.
that was my cut this year because of my participation, meaning premiums. The dollars that I put in buy me shares. My cut this year from the performance of the company, performance of the portfolio, performance of everything was $238. How much new insurance and cash flow did that net me?
It's like 6x. It's $1,237.
Let's go.
Let's add $1,000 onto the 238.
So what was crazy about this, Jesse? I'm talking to my buddy once again, and I said, hey, man, I could take the money.
Yep.
And I could spend that money, give it to Bank of America. I could do whatever I want with it. $238, Sean, $238, or I could pay it into the system. They'll do it for us automatically, by the way, but I could pay it back into my system, pay it into my life insurance contract of all crazy things out there, and it would net me $1,237 new dollars to play with. Sean, what do you think I should do? Should I take the deal? Take the deal, Howie, or no deal?
I'm gonna take the deal, Howie. Let's double down on that deal. If I can give them more, I'll give them more.
There you go. Okay, so I meant it the other way around. The analogy broke down. Take the deal meant like take 238, but nobody's counting. Yes, I said no deal in my scenario.
It the way that Sean did.
Did you?
Yeah,
okay, I was trying to do it backward. I was trying to do it the other way. Like,
okay, gotcha.
No deal. Don't send me the money.
Right.
Keep it in the system.
Right.
Okay,
Yes.
I tried.
I got you.
Very good. Hey, Nelson Hollins out there in Texas. What's up, man? Glad you're on our Facebook group right now. We've got a group called Infinite Bankers. That's a private group. We'd love to have you in there with Nelson and so many of us who are going to walk and talk you through your specific scenarios. One thing that I put in there this week, I'd like to jump into now that I'm going to get off my buddy who's in Hawaii doing the right thing and thinking the right things now. And that is there
really just are so many advantages, though.
Yeah, keep going.
It wasn't just that this guy had the ability to go from 18% down to 5%, which is a huge, huge opportunity.
Yeah.
But it was the added advantage of, well, as he's making those payments into this system now, like Sean said earlier, he's got access again as that's building up there. And then, there is this dividend that is on top of that. And then, there is the even worst case scenario of if in any point in this debt, because it happens, I'm not trying to fearmonger here, but if someone passes while they're in the middle of this debt recapture, what happens? That debt is not a problem anymore because where we were doing this from was a life insurance policy, and it's got this guaranteed death benefit. So there are so many advantages to doing it this way, meaning debt recapture instead of just snowballing debt.
I love it. There's two things that I want to talk about here out of that, because I remember that I wanted to tell you something that happened this past week that reminded me of where I am a shareholder and where I'm not.
Okay.
Okay. But what you just said around the dividend and the growth. Oh no, I lost that one.
Worst case scenario, if you pass, death benefit. So many advantages to doing it this way. Debt recapture. instead
Yeah,
of
I was just
debt
I got
filing.
really excited, and that's what I was thinking. Oh, that excited me about something because this system always gets better and becomes more efficient. But anyway, that 238 did turn into $1,200. It's the word passive. I did
Oh,
not
okay.
have to do anything to
Sure,
do that. That's what
sure.
it was. Why it was so
Huge.
exciting. That is literally passive income. Now, the paid up insurance, of course, is just a number inside the contract. I can make it active into my life by turning it into money anytime I call and request a loan or even withdrawal, but we wouldn't suggest that normally. Talk to your coach first. This is completely passive.
It's just running.
It's just running. I did not have to do anything to make that work. I did not have to check on it. There's no water heaters, no drywall, nothing. Jesse helped me move furniture last week. None of that. It just automatically happened. So I appreciate you there. Appreciate you there.
I got you.
Okay. The other thing was at my regular checking account. I still have a checking account. Jesse, you got one as well?
Yep.
Yeah. I got to have an Amazon card out there. So, we can swipe around the house. But I got a monthly interest payment from my checking account
Okay.
this past week.
Okay.
I took a screenshot of it. Okay, so here's what it is. This particular account, now I set things up the profit first way, so I use several different checking accounts, okay? So
Mhm.
it's not like, don't worry about that part.
Yep.
Well, a lot of us do. A lot of different checking savings
So
accounts.
many accounts.
Yeah, so many accounts. Okay, this particular one had $2,600 in it.
Mm-hmm.
Okay, 2676.82. Okay. I'm sorry, 81. 2676 and 81 cents. Sean, we're going to you. What was my monthly interest payment? Okay, kind of like a dividend, passive income. I don't have to do anything about. This one is going to be taxable. My policy, not taxable. I know y'all didn't hear me. Not taxable in that growth. This one taxable, but what was my monthly interest payment? This one comes monthly. That's cool. The dividend at the life company comes annually. Oh, not as often. But what do you think it was? $2,676.81. What was my interest payment that month from them?
You might have been lucky to get 2 cents.
Jesse, can you tell him how close was he?
You were pretty close. He got 2 cents.
2 cents. That is correct. I got 2 cents, passive 2 cents, taxable 2 cents, ladies and gentlemen. Took a screenshot for you. I think every once in a while we have to smile and just understand how efficient of a system this is for people.
Right.
And we're here to educate you first, ladies and gentlemen. It's not about buying a certain amount of dollars. Maybe your total net worth or your cash flow is $2,600. I don't know. Maybe you have more than that. But if you can turn your dollars into contractual guarantee of future cash flow towards your family, okay, towards you in life, cash values, towards your family in death, death benefit, income tax-free private, fully controlled by you, like Jesse said, I think that's something to smile about, baby, on a Thursday afternoon.
Mm-hmm.
Okay, what else do you have for us out there? Nelson is happy about
What's up, Nelson?
either my 2 cents or my 1,200. I'm not sure which one, but Nelson is maybe smiling as much as I was. If you are on Instagram, remind you to click that link in the bio. If you do that, you're going to be taken to several of our resources. Maybe you want to start at saveandspendsystem.com. That's going to take you to our hour-long presentation. It's recorded. It's free. We want you to get in there and watch and take down your notes. Just like Jesse, if you're still using pen and paper, you write down all of your notes. You ask your questions once or twice. Sean's got his ready as well. And what we're going to do is we're going to have a strong memory from those questions for our coaching call. And that coaching call is a free access pass to one of us or several other coaches on our team who practice this system personally.
Right.
So I always want to say that because it's not a sales tactic call. It is an education call where your questions can be answered about doing this process for yourself from someone who actually does it, who actually has bills, who actually has emergencies in our life that we can be prepared for. Jesse, I'd love to know if you've had any emergencies. I've got one, so we'll go around the horn and it'll end with me. Have you been able to use your policies? Have you have any events that have come up that made you shaken but not stirred? A little James Bond in there because you had cash.
So our most recent purchase was not necessarily a planned one.
Okay.
So we got a vehicle recently, and that's one of those things that you never know necessarily when it's going to go out. You should plan and anticipate for it, but we didn't know when. So that's something that we recently did. Got a video out on my channel for that. And what we did was we took the money and some extra, like Sean mentioned that extra earlier, of what we were going to spend on a vehicle, and we made sure to pay that as premium first into our system. And then we leveraged the insurance company's money to start that process of getting that new car. And we did.
I love it. I love it. Sean, any emergencies you've been prepared for, not because you knew the emergency was coming, but because emergencies come, you're prepared monetarily?
Yeah, I would say we had a fairly small one. My son had to get tubes in his ears. He's 16 months old, had to get tubes like last month because he kept getting ear infections. So for those parents out there, you know what I'm talking about. But that was a $900 expense. And of course, had the cash in our account, had the cash in our policy, but I knew I was going to have to pay that $900. So what I did was contact the company, our policy insurance company. I asked them, hey, do I have some extra space to toss this $900 in? They said, you sure do. Toss it in the policy, put the expense on the card because I want to get my points and everything.
Okay.
And then took a nice little policy loan, paid off the card, and now just got a nice little policy loan repayment going back to pay that $900.
Love to hear it.
Awesome.
All right. Mine was very similar. We all have boys around here. There's some girls and represented at these girl dad table right here. But
Yep.
Sean is solo boy dad right now. But my oldest boy snorted a Skittle. Yep. And now it was an organic Skittle. All right. Shout out to mom out there. It was an organic Skittle. It was very pale colored looking. I had one or two. Tasted delicious. Okay. Snorted one. Somehow, right? I mean, it went in his mouth, but he laughed, he coughed. He's 8 years old at the time. He's 9 now, but over the course of 8 to 9 in the last 6 months, the bill came from ER. Mom took him to ER because he's just in pain, right? The boy is hurting. You know something's wrong. Mom takes him to ER. They stay half the night. Y'all know how it works, right? So we're, hoping and praying he's okay. And he's fine. And apparently it had moved out of his nasal cavity before they got there, whatever, but he's in pain and hurting and whatever. But the bill came. And so, yep, but I was ready because my cash value. So these guys actually paid more premium in to their system. My system was capitalized to the point where I didn't pay more premium in. I just took the loan to pay off the doctor, the hospital, whatever, whoever's robbing you over there. $2,000.
Woo!
Okay, $2,000. But I had it. And I thought to myself, I'm not special. What I realized was because I prepared in advance, my policy was capitalized to the point where that I didn't feel it. I wrote the check. It was a physical check in this case. I wrote a check, came out a couple of days later. I did not notice for 2 reasons. One, kind of practical, one, policy. Okay, practical, I've split up my checking accounts, just like I showed you. So, like, I'm not begging Peter to pay Paul when emergency comes or whatever. Like, yeah,
organized. Yep.
Profit First, a little plug to that book out there. Get it, grab it, read it, good. Profit First. And number 2 was I had cash value ready to roll for an emergency. So that $2,000 I did not feel.
Organic Skittles.
Right? We thought we paid an extra 10 cents for organic bag. Nope, paid $2,000 for that bag. Right? Nelson, you know what I'm talking about? Okay, Nelson Hollins on YouTube says, I can't put it on the screen. I apologize. I don't know how. We got a few minutes left, but we got a question from him. Says, so is that payment considered? Thank you to Lincoln and Will. So is that, now I can't see it. It just got kind of small.
I got you. Yeah. So is that payment considered a cash dump?
Oh, great question. That word dump is very interesting because it can be jargon, but it means something within our system that we're talking about. So in both Jesse's case and Sean's case, I'm really struggling. Where in the world is it? In Jesse's case and Sean's case, yes. Okay, you could call it a dump. What we're really doing, no matter what, Nelson, it's premium.
Paying premium.
It's paying premium. Okay. But yes, in the nuances of the policy design, you might call it a dump. It's okay. You might call it flexible premium, paid up additions, PUA. All of these terms kind of mean the same thing, but don't be afraid to call it premium at all. Okay. Nelson, hopefully that was helpful for you. And that was a great question. So yes, a lump sum, a dump, flexible premium, paid up additions, PUA, flexible, all the same thing. It's premium.
Yeah, these policies that we're building for folks are built with those types of flexibility issues in mind.
100%.
Yeah.
100%. Yes. Good question. Good question. You've been listening, Nelson. You've been listening. You've been paying attention. Okay. Well, we've got a few more minutes here. So closing thoughts. We're going to go around the horn. We've got a friend on Instagram saying,
Go around the horn. You think people know what that means? I'm just curious.
I mean, there's a show on SportsCenter around the horn.
Yeah, I thought, like, now that we say it, like, horn probably does not mean baseball or baseball field. Horn probably has something to do with whatever Mountain Man is thinking and getting excited about. And I don't know, to be
Okay.
honest.
So there's some baseball context that
There's
Around the Horn
there's
means?
a SportsCenter ESPN show called Around the Horn. So I
Interesting.
always think of it because they even have a graphic. Am I right, Sean? They have a graphic that's a baseball diamond.
Yep.
So Around the Horn, there's several guys like this, like us, who are positioned on the screen around the field.
got you.
Yeah.
I
So,
thought of a completely different context.
well, tell me
Back-
what it is.
Back in sailing days,
Okay.
when people would go around the very bottom of Africa,
Oh,
or
yeah,
around
yeah.
the very bottom
The horn.
of South
Yeah,
America.
the-
South
yeah.
America, the horn.
Yeah. Very likely. Very likely.
Interesting.
Okay, we got a question
Didn't mean to
from
derail
our
you.
friends
Yeah.
on. No, we're good. But I want to answer my friend Raquel Zaldivar. What's up? Appreciate you being here. Are you talking about an IUL? Great question. Thank you for that comment. An IUL stands for something. Hopefully you know what it means because you have insurance in your handle. Okay, that is Indexed Universal Life Insurance Contract, which is a contract that does not have the same amount of guarantees as whole life. So no, we are
No.
not talking about it at all. An Indexed Universal Life Insurance Contract has flexible everything, and they don't carry the same guarantees of cash value growth forever.
I love it when you say it that way.
From our friends who sell whole life insurance contracts. So we do not suggest you try the idea of infinite banking concept with IUL.
Right.
There are great reasons and great conversations of why and how to understand that. But IUL often packaged on social media as the cure-all for this concept or retirement investing or whatever through insurance because there's a floor is not what I believe to be the best product for the process of utilization.
Yeah. And we've got a couple of minutes, Raquel. If you got a follow-up question now that you have that answer, let us know.
Yep. So most of now, Raquel, I'll say as you're thinking, as you're writing things down, Sean's had some experience with IUL personally as well. Maybe he'll jump in right after this. Is most of the marketing for several reasons all across the conversation of infinite banking, cash value, retirement income, or something with life insurance. Most of it is around IUL. Not here though. Sean, why is that? Tell us about your experience.
One, I think the probability for the commission to be higher is there. The way that we structure policies doesn't tend to work that way on the commission side. And
Now, Mom.
I think just kind of like when it comes to things being sexy, like the market's sexy, having these big returns is, potential returns is sexy. And so when you're taking an insurance product and tying it to the possibility of having higher returns, but still giving you some of the benefits that insurance does, that may appeal as a slightly more sexy. That's why people who promote it don't promote so much what we talk about, because ours is just guarantees. It is what it is. Sure, you can make it better by overfunding it, but it doesn't have that sexy appeal of the investment side of things. And I think that's where you're getting a little bit more into marrying an investment with a life insurance policy. we like to keep those two things separate.
Yeah. I'll say this, Raquel, but I appreciate you giving us response, that you're still here listening and all that. So thank you. It helps us to know that you're here and that we answered your question. We didn't get off track because we can do that. But an indexed universal life insurance contract is a universal life insurance contract, which is a term chassis with what most people call a savings component. Okay. So it is a term life insurance policy, meaning the cost of insurance rises. And you can show it in an illustration that it's not rising. So, don't sacrifice me on that. But the cost of insurance is rising. And therefore, the cash flows, cash values, it's not a guaranteed number. We don't know what's going to happen. Of course, there's outside exposure to the market, like Sean expressed as well. So those type of contracts are not built for the guarantees of cash flow throughout your whole, pun intended, life. So we're not going to use those. So we encourage you, if you don't know anything about it, grab the book, Becoming Your Own Banker by R. Nelson Nash. We suggest the 5th edition. That is the second to last one. The 5th edition, the Black Book. It is 90 plus pages. You'll love it if you're a thinker. Nelson Hollins is going to close us down. Jesse, read that one for us, and we're going to take things to the house, and we'll see you all next week for another Cash Coaching Hour right here. Nelson, what you got?
That cash dump/premium is a one-time payment and doesn't change your regular premium payment, right? Correct, Nelson. That can be an extra premium payment that you make above and beyond your regular scheduled monthly or annual, let's say, premiums, right? Because you want to build the cash value sooner. We do build policies with that flexibility. Appreciate the question. Definitely look forward to the next conversations with everybody.
Yep. Nelson, the premium is fixed. Extra is extra. That's up to you. You control it. We highly suggest it. We all do it. You heard it from these two guys.
Definitely.
But it doesn't actually change the premium that's due next round for you. Okay, Raquel's going to close us out. Psych. It's not Nelson at all. Okay. On Instagram, on the Banking Bros channel, follow us over there. I heard the word loan. That is why I asked you. Yeah. So you can take loans. You can leverage your policies in either case, universal or whole life. They both have the ability to grow cash value. And universal, I said that on purpose, not just index, but universal life, index universal life, variable universal life. If you have something super old, equitable universal life, whatever they used to call it back in the day. But that it's just not a guaranteed thing that's always going to be there. It's always going to cash flow or get bigger for you. If you take a loan from it and don't pay it back or miss payments, things that we talked about, or you decide to focus on your debt rather than pay, you could bankrupt your policy over there in the universal life space. That's why it's not recommended. I'm not saying it's bad. I'm not saying you shouldn't own one. And if whole life did not exist, I'm going to have to take a hard look at those IULs, to be honest with you. But since it does, I don't. So
Raquel,
appreciate you, Raquel. Go ahead,
quick
Sean.
Point, plug for the channel. Head over to the Banking Bros YouTube channel. Jonah, the other banking bro, and myself actually did a comparison video in our IBC versus series, IBC versus IUL. So look that video up. We go in detail through kind of those similarities, those differences. There are a lot of similarities, but the differences are what really separate them and make this why we choose whole life to do the infinite banking process. So go check that out over on the YouTube channel.
Awesome.
Appreciate the feedback, guys. Thank you, Nelson, for being here, and our friends on YouTube. We'll be back next Thursday, noon Eastern, to talk to Raquel and everybody else out there. What's up, the powerful Paola? Paola, great to see you. Congratulations on your engagement. Look forward to all your stuff out there. She's on Instagram. Hopefully she's still watching. If she is, love your stuff. Great to meet you last year in person. And shout out, send me a DM or something, and we'll talk more. Peace, guys. We'll see you next week.
Now tuned to the Banking Bros. Said we couldn't make it. Drink or settle. This the life we chose. Gave a lot of game. We never got a lot of things. Bow your head and say the prayer. We taught you how to be the bank.